Hey guys, welcome to the channel. I'm Liquid, and today we'll explore how to increase your investment returns while limiting risk. So keep in mind there are two important variables that determine how much money you can accumulate. The time invested, so the earlier you start, the better, and the rate of return. Of course, the higher, the better. Now, we've all seen charts like this where if you invest, say, $10,000 a year, assuming an 8% yearly rate of return, you will become a millionaire in 30 years. But what if you don't want to wait 30 years? Well, the time can be reduced if you earn a 20% annual return. The higher your rate of return, the less time you need to have the same outcome. The problem is, if you chase higher returns, you typically have to take on more risk. But what if you can invest in relatively predictable, low risk assets and still get a double digit return? Well, in certain conditions, that is possible. There's actually a practical way you can increase your investment returns without ever touching high risk assets. And by the end of this video, you will understand how this works. Since I started investing in my early 20s, my portfolio has always consisted of pretty reliable investments, such as real estate and high quality dividend paying stocks. I've never had the stomach to buy highly volatile stocks like Tesla, although sometimes I wish I did. Nonetheless, I was able to consistently make 20 to 30% annual returns and become a millionaire at age 32. So, what's my strategy? The underlying concept here is using controlled leverage. This means strategically investing with other people's money. This is already quite common. For example, if you have $20,000 and you want to buy a property that's worth $100,000, you have to get a mortgage. So that $80,000 mortgage is essentially other people's money that you are using to leverage an asset that you otherwise wouldn't be able to afford. Now, in this case, you're using a 5 times leverage because the value of the asset is worth 5 times what you put in. Leverage has a multiplier effect on investment performance. So if the house gains 10% in market value, you don't make just 10% on your investment. You actually make a 50% return because you have to apply the multiplier. On the other hand, if the house loses 10% of its value, you lose 50% of your equity. So it's a double-edged sword. The other thing to consider is that leverage usually comes at a cost, which is the interest rate you pay on the borrowed money. Unless, of course, you live in Denmark, where apparently mortgages are interest-free. Anyway, other millennials have also made a lot of money using leverage to generate wealth in the lucrative real estate market. But leverage works for all types of investments, including the stock market. Let's use the company Johnson & Johnson as an example. This is a classic large cap blue chip stock with relatively stable profits. It's been around for over 100 years. If you plan to own a company for the long run, it's hard to go wrong with a stock like J&J. Now, unlike a fast-growing technology stock, you do sacrifice the potential for higher growth, but in return, you get more stable returns and lower risk. So let's say you purchase 100 shares of J&J with your own money. If the stock goes up 10%, then your return is also 10%. Pretty straightforward. But let's see what happens when we introduce leverage. Say you buy 100 shares and then you borrow money to buy another 100 shares. So altogether, you have 200 shares. Well, this gives you a 2 times multiplier. So if the price of J&J stock rose by 10%, you'll actually make twice as much, or 20% on your money. If you lever up 2.5 times, your return will be 25%. So by using controlled leverage, you can basically earn the same juicy returns as a high growth stock without actually taking on the risk of owning a high growth stock. So you might be thinking, if leverage can exaggerate both your gains and losses, how can you make sure you don't lose money over a bad investment? Well, when it comes to investing, there are no guarantees, but what you can do is put in place a system that can greatly increase your chance to succeed. So I always use the following 3 criteria in my strategy. The first is you need to have access to low interest rates. So the cost of borrowing for you should be lower, actually preferably much lower, than the return you expect from your investment. That makes sense, right? Like if you expect a stock to return 8%, but you have to borrow money at 8% to buy it, then there's no point to use leverage. You would essentially be giving away all your investment gains to someone else. But if you can borrow at 2 or 3%, then it might be worth looking into. Let's look at J&J again. Consensus show that its earnings are expected to grow at roughly 8% on the conservative side. That's the expected return. But what about the cost to borrow? Well, right now in my margin trading account, I can borrow at 1.59%. That gives me a wide 6.4% margin of safety. This acts as a buffer, so even if J&J has 1 or 2 bad years, or if interest rates creep up, this strategy should still be profitable. J&J also pays a 2.5% annual dividend, more than enough to cover the cost of borrowing. But what if borrowing costs go up and you have to sell? Wouldn't you risk taking a loss? After all, higher interest rates usually have a negative impact on the price of real estate and the stock market. Well, that's where the second rule comes in. Only buy high quality assets. High quality investments tend to perform well despite interest rate policies. So here's a look at the federal funds rate over time. The Fed sets the base interest rate in the US. When the economy gets too hot, the Fed raises interest rates to cool things down. And when there's a recession, rates are cut to get people spending again. I'm going to highlight here in yellow all the times when the rate increased considerably. Now, here's an overlay of Johnson & Johnson stock. Notice how at the end of every Fed tightening cycle, J&J stock price is higher than where it was at the beginning of the rate increases. So if rates move higher and you decide to no longer use leverage, you can simply sell your J&J stock for a profit. But again, there's no guarantee. Just because this happened 4 out of 4 times in the past doesn't mean next time will turn out the same way. And even though J&J stock is pretty solid, it's not immune to systematic risk. So you may have some doubts, like what happens if you lever up a quality stock at a suitable interest rate and then your investment suddenly falls 20% like in March of 2020? That can certainly happen. Well, this is where the final rule comes in. You want to hold each investment for at least 10 years, but of course, the longer the better. Famous investor Benjamin Graham said that the stock market is a voting machine in the short run, but in the long run, it is a weighing machine. The market only prices in events that will happen over the next 12 months, not 12 years. So having a long term perspective is a huge advantage. Stocks will always be choppy near term, but if you zoom out and look at J&J, it's clearly heading up over time. This is why I bought more shares in 2020. I like to buy profitable companies when others are fearful because that's when stocks go on sale. And then I simply hold and wait while others buy back in and the stock market recovers. Wealthy people use controlled leverage all the time. Even Warren Buffett's company Berkshire Hathaway is levered 1.6 times so it can generate higher returns. The National Bureau of Economic Research put out a paper that says Buffett's returns appear to be neither luck nor magic, but rather reward for the use of leverage combined with a focus on cheap, safe, quality stocks, which is basically what I've been highlighting in this video. This is what I've been doing for over a decade, except I typically use a higher leverage multiplier than Buffett. But this shows that leverage can work for both small retail investors and for large institutions. Now, Buffett has said that you don't need leverage to make money, and he's absolutely right. But when it comes to learning from billionaires, it's more useful to watch what they do rather than what they say. Personally, I bought my first property with a small down payment and built up equity over time. I used 8 times leverage when I bought my farmland in 2012. I then sold it 7 years later to lock in a triple digit return thanks to the help of other people's money. I frequently lever 2 times to buy stocks, and luckily, the last 10 years have been an incredible run for the stock market. As my assets grow and my liabilities shrink over time, the gap between the two expands exponentially. This accelerates wealth creation. If I had made all the same investment decisions from the beginning, like buying the same stocks and everything, except not use other people's money, it would probably take me 36 years to become a millionaire. That's because by the time I can save enough on my own to buy those investments, their prices would probably be a lot higher by then, and I'd miss out on all those gains. But due to leverage, I was able to reach my 7 figure net worth goal in just over 10 years. But the truth is, leverage isn't for everyone. It's important to remember that the 2010s was an exceptional decade. We saw high asset price inflation and rock bottom interest rates. That's the perfect environment to leverage a portfolio. So I happened to use the right strategy at the right time, but this may not be the case in the future. And the three rules are meant to be a starting point to screen for possible assets. But deciding whether or not to actually make the leverage investment requires a lot more scrutiny. Investing is very nuanced. You have to think about your liquidity situation, margin requirements, asset allocation, inflation, disinflation, risk tolerance, diversification, taxes, macro trends, and personal circumstances. It would be prudent to consider all of these things before deciding to lever up on any investment. But the point of this video is to just share what I've learned and highlight the use of credit from an investment angle. For sure, if you aren't careful with debt, it can ruin your life. but if you take the time to understand it and control its usage, then maybe debt can be an effective financial tool to help you reach your goals sooner. Anyway, thanks for watching this video. I hope you got something useful out of it, or at least gained a new perspective. Leave me a comment if you have any feedback, and feel free to subscribe if you want to see more content like this in the future. Until next time.